Hello, hello. Intel is a company that I really love for long-term investing, and it has gone down so much that it makes for a very interesting opportunity. Today being down about 5%, sitting at near 26 bucks, actually less than 26, down more than 50%. And I have long talked about this company, and we have had a lot of discussions in our Discord channel. Obviously, in this current market, it could go down even lower. Now, I don't really know whether that's going to happen. It's possible, but maybe it also goes up from here. But what I do want to examine is whether this current price and this company is maybe worthwhile for adding to a portfolio for the long term, for the long run. And so even if it goes to 20, then if it heads up to 40 or 50, who cares about that? Because when we're buying for the long term, we cannot really be looking at these price swings. Now, if you are swinging the company, if you're actually aiming to buy this today and sell it a month from now, maybe, just maybe, it's worthwhile waiting a little bit, see what the current trend is. Although, of course, you can never really know. And today, 5% is a pretty steep decline. Maybe worthwhile for even getting for a swing. Now, we do know that the latest quarter of the company has been a massive disaster. We have talked about this one. We are going to examine it in this video as well, just to get a little bit of a sense of what the company has been doing. But remember, all of these factors have already been priced in. Now, the bad quarter, the bad guidance, everything is already priced in. It may still cause a little bit of an upset in the company stock price, but investors are aware of it. And so, as things in the next few years, I hopefully at least, will be getting better. It is then when the stock price will going to start climbing again. It may take a little bit of a while, but if you get it at a cheap price, who cares about what is happening again in the short term? Now, if we take a look at the P ratio of the company, you'll see it sitting at 5 to 6 or so, which is tremendous. I mean, this is down a lot from what it used to be. And the same thing with the price to free cash flow. Now, the price to free cash flow is a little bit more elevated because remember that the company is investing a ton in capital expenditures. So this is why their free cash flow is actually a little bit higher, the ratio that is, compared to the P ratio. So that wouldn't really concern me at all. The company has also been buying back shares, and frankly, they should keep buying back even more, a lot more, I should say, because the price of the stock does look cheap. Now, we will examine whether it is cheap or not in more detail a little bit later. Now, the revenue growth of the company has been stalling, and it seems to be getting a little bit worse even. The net income growth also stalling lately and potentially getting a little bit worse. With the same thing with the free cash flow growth, and we still could see the company have less revenue growth. It is projected to potentially have some declines as well in the upcoming year. And so you may be thinking to yourself, if we know that the company's revenue is going to drop like 5-10% next year, why buy today and not just wait for the next year? Because the thing is, this is already priced in. People know about it. It's not news. And so the price of the stock and the decline of the stock already includes this kind of information. It's a known fact. And so even if we get an earnings report that is bad and expect it to be bad, like the company's revenue is down 10% or 8%, it could still be a positive for the company. We could still see the stock price go up because there may be a slight surprise. Maybe their guidance is better, or maybe their EPS is a little bit higher than expected, and then the stock price soars, and then you are like, okay, why is this happening? Isn't this supposed to go down even more as the revenue keeps dropping? But that's not exactly how earnings reports work. And so you may be thinking that the company still continues to do badly, but again, you have to remember that this is a known fact, at least for the upcoming year or year and a half or so. Now, what has happened with the company's latest earnings report? Let's take a little bit of a closer look at that too. That one, in case you don't remember, was a massive disaster. The company stock price fell a lot in that news. And you will see that the earnings that they had was 29 cents per share versus 70 that was expected. A revenue of 15.3 compared to almost 18 over here. So there was a decline in Intel's revenue, a pretty big miss over here, and they ended the quarter with a 454 million net loss compared to net income of 5 billion in the year ago quarter. So it was a massive disaster that quarter, a really bad quarter. Now again, remember that this is known information, and we do know about the guidance as well, because the company also declared guidance here, and there was, they have slashed their full year guidance pretty much. So again, these are news that we know that they are going to happen. So you may be looking at the company stock price being at low levels or similar levels to where it is right now. Now, would you be waiting on this one? Again, as I told you, sometimes there could be surprises, and then the stock goes up regardless, especially if it has been beaten down a lot previously. Now, what I do like to see here is the semiconductors that are likely to benefit most from CHIPS Act aid, which President Joe Biden recently signed. That is good news for semiconductors, of course. It is a little bit of a lengthier thing. It's a long-term thing. But again, if you are looking to buy for a long-term portfolio, that should be good for you, and you should be looking at it with a visionary eye, I should say. And there are going to be some subsidies here, 25% investment tax credit for cheap lands and things of that sort. And as you'll see, Intel, seen as top CHIPS Act winner, likely will be the biggest beneficiary of the CHIPS Act, Bank of America securities analyst Vivek Arya said in a recent note to clients. So again, this is something that I love to see. Estimated that Intel could see 10 billion to 15 billion worth of US government subsidies. Nice to see. And similar things are mentioned here pretty much. Likely beneficiaries, Micron as well, Global Foundries too. So yeah, we're potentially looking at semiconductors coming back with a vengeance eventually after they have been beaten down so much. And this is why I would really like to be taking a closer look at this one. This is why I'm making this video. And in fact, it's going to be one of the stocks that I'm looking to be adding to my portfolio very soon. Now, the thing that I don't like is the fact that they are paying a hefty dividend, a very hefty dividend, and a dividend that is a large percentage of their free cash flow payout ratio, as you'll see here. Now, it's not so much in terms of their net income because remember they're spending a ton in capital expenditures. That is a good thing, of course, because the good capital expenditures can be tuned down, for example, in order to be able to confidently pay your dividends, the dividends that you have to pay to shareholders. So it may not be a huge thing, frankly. And if we take a look at the company's dividend stub here, you will see that they have been increasing their dividends pretty much every quarter, every year. And the thing is, it's currently, that's the effective one right now with the current stock price at 5.6%. That is very lucrative here. I want us to do a little bit of a calculation here. Let's just say, and let me bring up the calculator. Let's just say that we decide to keep this one we buy today, and we decide to keep this one for 5 years. This is going to be 5 multiplied by 5.64 right now. So we're getting almost 30% return on our money just from the dividends. And do you think the stock price is going to be lower than today? Maybe. But likely in 5 years, I would think that the company stock price will actually be higher, especially given the fact that there are going to be quite a lot of good things for the companies based on the CHIPS Act. So you may be looking at it right now and be like, okay, things are looking dire for the company, but what about the long term? You should be thinking like that. And again, this is a 5.64 year, so in 10 years it's going to be 56%. You're getting more than half of your investment just from the dividends. And what if the company stock price is at 50 or 60? And I think it's going to be, frankly, but we'll see, of course. You never know for sure, but you will see that this has been trading at a near 60 or 70 quite a few times in its past. And frankly, I think that eventually it will go back up there. It may take 5 years, for example. But if let's just say that it happens in 5 or 10 years, doesn't this seem like a nice return on investment with a relatively low risk? It does to me. Now, could it go down lower? You will see from its past that it could go down lower. This is why you may want to wait it out a little bit. We have seen multiple prices near 15 and 20. 20 may be a nice one to actually wait for because there have been quite a few 20s here, as you'll see in the past. And that matters for traders. So you could be seeing this kind of decline at some point. 20 could be the price that would be an amazing one to be buying this one, frankly. But even now, it could be a nice price. And again, since we're not really swinging this one, let's just examine whether it makes sense to buy today. And if we take a look at our stock evaluation tool, I'm going to go in negative territory. Minus 5% a year is what I'm going to try. We don't really expect that low or that much of a decline. Frankly, analysts think that this could go down like 10% in the first year and then start growing again. But I'm going to go minus 5, 0, and let's just go 2 here. In terms of margins, they're sitting at about a similar level. I'm going to go just a little bit lower here in the case that margins get lowered. And in terms of free cash flow margins, they're sitting at about 80 to 90 and 100. So that's the typical ones. 13% of an annual return. And what are we getting here? Now, comfortably, again, 37 is going to be the low one. and this is a minus 5% revenue growth. So with a company not growing at all from what it is today, basically doing the same revenue for the next 5 years, we're looking at a comfortable $55. And again, remember, companies revert to the mean eventually, and I really, really expect them to reach this price at some point, and even more, frankly. Again, it may take a while. Don't get me wrong. Again, this current market right now is a market that things tend to go down, and this could go down even lower. But it just may be like if you are looking to add a little bit of Intel to your portfolio, it may be an interesting choice to start averaging down even from today, beginning today, because this one is at a really, really nice level over here. And as I said, it's one that I'm going to be adding to my portfolio. I'm looking to add to my portfolio pretty soon. I really like what it is right now, and yeah, even though it's paying a dividend, I'm not a big fan of. What I explained earlier, the fact that you can make some risk-free money over the years, and yeah, again, this doesn't look like it has a lot of risk for your dividends, at least. I like what I'm saying. So yeah, that's what I wanted to talk about in terms of Intel. Let me know what you think about this company, and remember to leave a like and subscribe. I'll see you in the next video, guys. Bye bye.